Good afternoon, everyone. Welcome to JMT's Expert Speaker Series. We're going to wait another minute to get started. We still have some people logging on, so please be patient. We will be right back. All right, thank you again for joining JMT Consulting for our Expert Speaker Series today. We are happy to have Matthew Brescia from BDO presenting today on 2019, What to Expect for Nonprofits. This webinar is sponsored by JMT Consulting. We are an ERP and financial management solutions firm with 27 years experience that specializes in nonprofits. We work for a wide variety of software partners to find the best solution for your nonprofit. I'd like to share a few housekeeping notes and then I'll turn it over to Matthew. If you have any questions during the webinar, please submit your questions in the questions box on your control panel. We will answer questions at the end of the webinar. You will also receive a survey at the end of the webinar to tell us how we did today. And today's webinar and slides will be emailed to you as well. Finally, I'd like to introduce Matthew Brescia. Matthew is Assurance Senior Manager in the Nonprofit and Healthcare Practice in the New York metro area offices of BDO USA. He has devoted the past 12 years to lending his expertise to nonprofit organizations with the fundamental goal of fostering a reputation of diligence, adaptive insights, and tenacious loyalty. He has extensive experience in designing and executing financial statement audits with a tailored emphasis on social service, government-funded, donor-driven, and aesthetic-directed organizations. He has spoken on a wide breadth of topics affecting the nonprofit industry, including nonprofit financial reporting and governance, never shying away from an opportunity to provide guidance and instruction on new and existing audit and according standards. We are happy to have him with us today, and with that, I'll hand it over to Matthew.
All right, thank you, Melissa. So hi, everyone, again. I'm Matt Brescia. I'm the Senior Manager at BDO with the Nonprofit Practice. And for today's webinar, I prepared really a two-part presentation. The first part, I'm going to go over some of the accounting pronouncements that are currently in effect and will be affecting your financial statements next year, as well as the second part, which will be the results of a benchmarking survey we did at BDO of 100 non-for-profit entities, where we got feedback about the concerns, challenges facing these organizations this year, as well as looking forward to 2019 and beyond. So I'm sure everyone is aware of the nonprofit financial statement presentation changes, also known as the Accounting Standards Update 2016-14. This is actually in effect for calendar years for 12/31/18. So as you're reporting this year, you should have been in compliance. However, I know many organizations with 12/31 year ends, you're gearing up, starting your audit in January and February, issuing your financials early next year, where all of these changes will have to take place. So over the next couple of slides, I'm going to quickly give a recap of what that is. I know many of you have probably been through these trainings at nauseam, know all the changes, but for those of you who may have been, living under a rock for the last couple of months, I think it is important to just revisit some of these major, more pronounced changes to the nonprofit financial statements. So the key provisions of the Accounting Standards Update 2016-14 are really 5 main changes. You have the changes to net asset classifications, changing the names from unrestricted, temporarily restricted, and permanently restricted. So now you're going to have 2 classes with donor restrictions or without donor restrictions. Regarding liquidity and availability of resources, new disclosures are going to be required in the financial statements surrounding which assets, financial assets in particular, are available to fund operations for the year, as well as notes in the financial discussing the qualitative measures of liquidity, such as how the organization funds operations, does it utilize a lot of credit, does the board have to get involved in appropriate amounts from endowments to fund operations, and so on. Regarding expenses, a statement of functional expenses is now going to be mandatory for nonprofit financial statements, where in the past Only healthcare organizations who are nonprofits were required to have this within their notes to financials. Now all nonprofits are required to report expenses, not just by natural classification, like salaries, fringes, office expenses, and so on, but now by function, similar to how it was always required on the Form 990. There'll be some changes to the investment returns regarding how the presentation of investment return is going to be presented on the financials, which we'll go over, and a small change regarding the statement of cash flows. So as I touched upon earlier, the effective date was years beginning after 12/15/17, which would have started January 1st, 2018. So these December year ends that are coming up, this ASU should have been implemented, and I hope those of you on this call who have to follow these guidelines for nonprofit organizations have already started hashing out pro formas, getting feedback from members of governments, working with your auditing firm to make sure that your financials going into the new year are going to be in compliance when it comes time for reporting. For those of you with fiscal year ends, you have a couple more months to fully implement, particularly if you're a June 30th year end. This will be for the June 30th 19 financials. So let's quickly go over a little more detail, a couple of these changes. I'm not going to spend too much time, but again, just to give a pretty good overview. With any of these changes that I go over for the nonprofit financials, you have to remember the whole purpose of this experiment, this project, had been to make financial statements of nonprofits more transparent to the end users, which are those in governance, the board of directors, as well as donors and the general public. So under the current GAAP, as all of you probably know, net assets are broken into three required categories: unrestricted, temporarily restricted, and permanent restricted. Under the new guidance, we're going to do away with a lot of that verbiage, the unrestricted verbiage, and it's going to be turned into without donor restrictions. Specifically, has a donor given you money or assets that have been restricted by purpose by the donor specifically? On the other hand, you'll have with donor restrictions replacing temporarily restricted and perm restricted. So now the financials won't have to qualify those amounts between permanent or perpetuity or amounts that are held in endowment versus the temporarily restricted, amounts restricted for specific programs or periods. What is going to change, though, additionally, is that some of these without donor restrictions amounts that have been designated internally, earmarked by either members of management or the board of directors, are going to require additional disclosure requirements in the notes of the financial statements. So in the next couple of pages, I just, for convenience sake, took snapshots of examples from the ASU itself. Won't sit here and go through them in detail, but they will be included in the slides that are eventually circulated. So, use these as a resource. As you can see on the statement of financial position, the breakout of net assets is now without donor restrictions and with donor restrictions, as opposed to temporarily restricted and unrestricted, with applicable no references to the notes of the financials. For the statement of activities, you have changes regarding the same changes in net assets, where you have without donor restrictions a new column. This would have been, for some organizations, two separate columns. Again, the temp restricted and perm restricted net assets be consolidated into one column. And the next slide is just another example directly from the ASU. So additional disclosures to consider related to net assets. The whole goal here, again, is for the reader of the financial statements to have a better understanding of which of the organizations' net assets are available to fund general operations. You always have that question on donors' minds: how liquid is the organization? And sometimes you have a bloated balance sheet where you'll have fixed assets that take a majority of your net assets. Those are not easily turned into cash. And when you want to make payroll, you can't sell your building if you want to keep your mission running. So again, the purpose here is to show donors what is available to be spent for operations. So regarding net assets, here's an example again from the ASC with disclosures type. With donor restrictions, you see it's broken out here. Perpetual in nature, very similar to what we would call currently permanently restricted. Purpose restricted. This is your program restricted net assets, and again, time restricted. Those contributions that are earmarked for future years by the donor. Without donor restrictions, it's broken out here, designated by the board. If there's a specific purpose, you would leave it here or detail that out. If it's for a board-designated endowment or an appropriations fund, that can all be broken out here. And then lastly, you're left with the undesignated. This is generally, basically your general operating net assets to be used to fund current year operations. In regards to net assets, there will also be some changes to how underwater endowments are being treated. For those of you who are unfamiliar with this topic, underwater endowments are funds given by a donor for an endowment where the historical cost or the original gift amount of that endowment has fallen below that value for fair market value reasons of the underlying investment. Currently, GAAP requires transfers between the current unrestricted and temp-restricted net asset columns. This has led to a lot of negative feedback, and individuals who have no idea, about accounting, never mind not-for-profit accounting, left shaking their heads and trying to understand what is happening on the income statement or statement of activities. What's going to happen going forward with the new ASU is that this is all going to be reflected within the temporarily restricted net assets column, hoping to clarify the amounts that are being owed to back and forth between the net asset funds. Another change regarding net assets is the expiration of the capital restrictions. What this is for sometimes, individuals or foundations will grant money to an organization to fund capital projects where the amounts are being capitalized on the balance sheet and then depreciated over time. Currently, or under the previous standards, organizations had the option to match the release of those restrictions with depreciation or release it when the assets are placed in service. The new ASU is going to simplify this, and for all capital contributions going forward, these are going to be released upon when the asset that's restricted for the use is placed in service. Any assets that were capitalized and are being depreciated and matching that with temp restricted releases under the old model will continue out their life, but anything that's new that comes in will now be required to be released from restriction when that asset is placed in service. The next area of the financial statement changes is regarding liquidity. Really, two main facets of this are going to be qualitative and quantitative information disclosed on either the face or the notes of the financial statement. An example of some of the quantitative changes, this is directly from the ASU, where you see the organization is detailing out the financial assets that are going to be available to use within 1 year of the balance sheet date to fund general expenditures. This year is simply showing, cash, accounts receivable, contributions receivable that are short-term, due within 1 year, investments and other investments that can be used to fund operations. Additionally, in the notes, there's disclosures on more of the qualitative measures of liquidity and how an organization decides it's going to fund itself. This example, again, is directly from the ASU. In this example, the organization is talking about how it funds itself up through its endowment, through appropriations, the availability of lines of credit, as well as spending from its quasi-endowment. And again, when you take a look at this for your organization, it doesn't have to be as big as this. Some organizations will have one twice the size, depending on how their operations are structured. So again, you want to give yourself time to take a look at this stuff because it is now going to all be a requirement going forward. And lastly, one last example for the quantitative disclosure. You can see this organization in the example is taking all of its financial assets at year-end. Financial assets meaning those that can be converted into cash within the current year. So you're going to back out property, plant, equipment, inventory, and any prepaid. And it's backing that number, taking from that number, backing out assets that are earmarked for other purposes, whether through donor restrictions and time, investments that are held in an annuity trust, quasi-endowments, and then assets set aside for liquidity. And this is what you're left with at the end of the day to fund current year operations. And you can see in this example, as a big driver of these changes is that this organization, through an unsophisticated reader, is showing nearly $235,000 of financial assets at year-end. But at the end of the day, when all said and done, you only have $5,000 in assets available to fund resources. And that's a big difference when it comes, times reporting and looking at liquidity and looking at liquid unrestricted net assets. So in regards to expenses, as I mentioned earlier, the big change here now is for organizations who hadn't, either voluntarily or mandatory, had a functional expense schedule in their financial statements, this is not going to be required. As many of you who prepare this now know, it can be time consuming, particularly if you're not tracking expenses by function throughout the year, and you have to go about doing this more of a manual type exercise at the end of the year. It can take quite a bit of time, and your auditors are going to want to have this in advance and be able to test it as part of their audit. So it's important to get this under wraps and get this started as soon as possible. But basically, for those who haven't seen a functional expense schedule before, it's the classic matrices where you have one side, you have your natural expense accounts, depreciation, repairs and maintenance, contracted fees, legal fees, salaries, fringes. In columnar, you have the different programs of the organization with administrative, management in general, and then fundraising expenses. So what the requirement is, at a minimum, is you want to segregate out program, fundraising, and management in general expenses, similar to what the 990 is currently presenting and has been presenting for years. And again, organizations have the option to give as much detail as they want. You can break up programs into, if you have 7 programs, you can have 7 program columns. If you want to consolidate, programs by different types, you can have 1, 2, 3, 4, 5. It's really, the goal here is what do the end users want? If you're a donor-driven organization, you might want to show as much detail as possible regarding certain programs because it could help in your fundraising efforts. If your end users, or if you're not raising funds and your end users or your board of directors and they're getting, monthly reports from you in detail, you may not need, 7, 12 functional expense program columns. You may be happy with just one for presentation purposes, which ties to your 990, and then internally you can review with the board as necessary the bigger profit and loss by class. Another change is going to be requirements in the notes to the financial statements regarding how expenses are allocated. So for organizations who are recording expenses and allocating them by certain metrics such as square footage, by hours worked in different departments, anything that's not directly recorded will have some required disclosures in the notes to the financial statements. Nothing too specific, but definitely to give the reader how these amounts are being calculated and what metrics the organization is using to determine these allocation ratios. And lastly, there's going to be enhanced guidance on allocations that came with the ASU. So particularly regarding direct conduct and direct supervision and how those expenses should be allocated, there is some additional guidance that the FASB has put out regarding those. So, as you get started, as you look at your functional expenses, it's important to keep these new requirements in mind. So for investment return, here a big change that's happening is that organizations have been required now to show the net presentation of investment income. Where previously under GAAP, you had to break out the different types of investment revenue, like unrealized gains, realized gains, dividends and interest, and then disclose the amount of expenses that are being directly charged to those investment returns. This is going to be no longer required. Furthermore, you no longer need to show those different types of investment income. It can all be consolidated into one net investment income line. Additionally, with the investment return, any internal salaried individuals who directly, actively manage your investment organization's investment portfolio, those expenses now are going to be taken off out of your salaries, which would appear in the functionals, and be, based on the percentage of time worked, directly netted against your investment revenue. And this includes salaries, benefits, travel, and other costs associated with any officer or staff responsible for the development and execution of investment strategies. This is not people who reconcile investments for bookkeeping purposes at the end of the year. This is an internal person who's acting as an investment manager, like you would pay for a third party to manage your portfolio. They're developing a strategy, they're helping execute trades, they're looking at long-term returns and how to better manage the portfolio, and so on. And any costs associated with internal investment management and supervising, selecting and monitoring of external investment management firms, that can also be taken and netted against investment return. They do not include, as I mentioned, items that are not associated with generating investment return. So costs associated with unitizing an endowment fund, or again, any sort of clerical or bookkeeping work regarding the investment portfolio would not fall under this investment return jurisdiction. So a couple of issues reporting in the investment return for implementation purposes. Just keep in mind, it's only the net amount of investment return that's going to be presented. Programmatic investments, some organizations or microfinance organizations, as part of their programmatic mission, they give loans or investments in lower income individuals, startup companies overseas and less developed nations. If it's a programmatic investment, that's going to stay as part of your program activity and stay out of the financial activity and not be subject to these investment income presentation changes. To comply with this presentation, organizations should need to fully understand the definitions of these terms and consider how to appropriately and accurately capture this information. And again, familiarizing yourself with this stuff and running examples through the board of directors and other members of management, making sure at the end of the day you have your auditor's approval is paramount in any of these changes. So the cash flow statement, simple change here. In the past, GAAP had always required an indirect reconciliation if the direct method of cash flows had been chosen. This new ASU will get rid of that. So if your organization has or would like to use the direct method, which some organizations believe better presents the cash flows for the end user, you will no longer be required for the indirect reconciliation per GAAP. If you had always done indirect method and you want to continue that way, you'll see no change in your cash flow statement. All right, so with that, the next topic, which will be in effect for almost all nonprofits, will be the revenue from contracts with customers during 2019. And unlike the ASU 2016-14, the financial statement project, this revenue from contracts with customers, you really should see an effect immediately effective January 1st, when revenue is starting to be recorded internally. Whereas with financial statement changes, you had 12 months to do business as usual, and now when you're getting ready for your audit to issue your financials, you got to really consider the presentation changes. With this revenue from contracts with customers, this goes into effect January 1st, and how you're recording your revenue on your general ledger throughout the year will be immediately impacted. So the quick overview, again, the purpose, there's always a reason behind these changes, and the purpose here is that it's ultimately to get U.S. GAAP in convergence with international accounting standards. This standard aims to improve accounting for contracts with customers by basically getting every organization on the same page. Every type of organization, every type of business should be following these same 5 steps in order to record revenue. In the past, you had industry-specific methods of revenue recognition. If you want to try to compare revenue recognition between 2 different companies and 2 different businesses, you would oftentimes find 2 or 3 different ways of recording the same types of revenue. So the scope of this ASU is every type of contract with a customer, whether it's written, whether it's implied, except for lease contracts, insurance contracts, financial instruments, guarantees, or non-monetary exchanges in the same line of business. Contributions and collaborative arrangements are not included in this for contract purposes. So for anyone who may not be familiar with this yet, what this ASU does, it gives 5 criteria for recognizing revenue. Those are identifying the contract with the customer, identifying the performance obligations, what each party owes to the contract, determine the transaction price, allocate the transaction price to the performance obligations, and lastly, recognize revenue when a performance obligation is satisfied. So here are a couple of ways organizations can prepare. Become familiar with the new standard. Obviously, a lot of accounting firms have been putting out a lot of material on this rev rec change, how it would affect your organization. There's myriad of resources available online to get this process started and get the information that you need. You can work with your accountants, external, your auditing firm. A lot of auditors, we have to remain independent. We can't give the answers, but we can definitely point in the right direction. And more importantly, give your organization examples of what other similar organizations are doing in the processes that they are going through for the similar revenue streams. You want to make sure that all of your revenue streams are being inventoried and accounted for. If you have 6, 7, 8, 9 revenue streams, you want to look at each one individually and apply those 5 steps, because you may see differences in the way that the contracts are structured versus some of your other revenue streams, and when you recognize revenue could be dramatically different from how you're currently doing. You want to evaluate whether there are differences between the current practice and the new standard, and furthermore, look at how those any of those changes are going to affect your financial reporting throughout the year. Regarding the acquisition of contracts, historically many nonprofits have not tracked these costs, and in order to maintain compliance with the new standard, I've been recommending to my clients, and I recommend looking at each contract individually and looking at the wording in the contract. Any costs associated with obtaining that contract, those will now be accounted for under the new RevRec standard. You want to identify gaps between what is presently available and what will be needed for the required disclosures. If you're reporting now certain contracts and bundling revenue streams, and it's all hitting your statement of activities, and there's no further disclosures in the notes, and now under new RevRec, you're going to have to break these down and add the additional disclosures to financials. You want to get your ducks in a row now and figure out what kind of information you're going to need from your internal teams, as well as from the contracts themselves. And most importantly, you want to consider preparing mock-up financial statements. There's no better way to look at the changes and how they're going to impact end users than by running them through your financial statements, getting feedback from the board, getting feedback from other members of management and the revenue department heads, and quantify these impacts in one place. So connected to the RevRec changes, FASB also this year in 2018 released some clarification regarding contributions and grants and how to discern the difference between the two. As you remember from the previous slide where I said contributions were exempt, this only gave rise to more questions when organizations, specifically those who receive money from federal, state, or local governments, had to discern which kind of money from the federal, state, and local governments should be treated as a charitable contribution or a non-like-kind exchange, or as a grant where there's some sort of reciprocal transaction taking place. So this additional ASU applies to all entities, even though it's mainly specifically tailored to nonprofits, because again, they're the ones receiving charitable contributions. It excludes transfers of assets from government entities. It applies to both contributions received by a recipient and contributions made by a provider. It also does not distinguish the language or verbiage used in your financial statements. For example, contribution, grant, donation. The words you use have no meaning on how revenue should be recorded. It's really about what's happening in practice with those revenue streams. So whether one organization calls money from the federal government a grant, the other one calls it a contribution, if it's the same grant and it's for the same specific type of work, both organizations should come to the same place and record it as the same type of revenue, regardless of the name they give it. So as I mentioned, what happens, this is a little bit of a background on the slide. ASU topic 606 came out, exempted contributions. It just led to more questions about federal and state and local money. Should they treat it as a contribution or as a like-kind exchange or reciprocal transaction? And then once you determine whether it's reciprocal versus non-reciprocal, are there conditions attached to it that would prevent you from recording it as a contribution within the year received? And so the main driver here is, again, these federal, state, and local contracts. Under the current practice, an exchange is considered when this money comes in, regardless of whether there's a resource provider that has commensurate value in exchange, or any time a government may give money to an organization, and that government entity is getting a resource with equal value back to a specified third party. If there is federal money or state money that's, for instance, funding Medicaid to a nonprofit who performs services on an unrelated third party, again, that's an exchange transaction in the current practice. And then if the government entity gives money to help the general public through the nonprofit, again, it's historically been considered an exchange transaction. So what the new standard means to do is clarify this. So if a government entity gives resources or money to a nonprofit organization and that government entity receives commensurate value in return, that'll continue to be an exchange. They give $500,000, the nonprofit organization gives something back to the government entity. It's a classic contract. There's no terminating of a non-exchange there. There's no contribution. There's no intent to give without receiving anything. You're not receiving anything in exchange. In instances, as I mentioned, for social service organizations who may receive state and federal Medicaid money to help, their mission-based consumers, that'll still be a contract exchange. The government's paying the organization money through Medicaid program. The nonprofit's performing a service for the third party. It gets reimbursed for those costs to perform that services. An exchange has taken place. What changes now is that when federal, state, or local government money is given to fund the general public, so outside of the mission-specific individuals for that nonprofit entity, that can be considered a contribution. And now where it gets a little bit trickier is for third parties that there doesn't appear to be an exchange transaction. Coincidentally, it is colored gray here, and it definitely still is a gray area, as you can see by the asterisks. It's still, FASB is still determining what to do with these and whether, how to benchmark performance obligations for this, and ultimately whether there's conditions attached or no conditions attached. And on the next slide, what I'm going to do here is kind of give a little bit of a breakdown of what the indicators are to determine these barriers between conditional versus unconditional. And if you're helping a third party through your mission with government money, if there are conditions attached, you will have a different way of reporting that versus the no conditions, where that's ultimately similar to what a charitable contribution would be. So if there's an inclusion of a measurable performance barrier related to or other measurable barriers, there's probably a condition. Whether there's a stipulation is related to the purpose of the agreement, whether there's something the organization has to do in order to get the money, and the extent to which the stipulation limits the discretion by the recipient. Sometimes you get stipulations, that it needs to be used, and the reason is very vague, basically just a restatement of your organization's mission. That's not considered a severe stipulation that will require or prevent an organization from recording that as conditional. And as you can see in the next slide, give a little bit of a flow chart to help organizations discern what type of revenue they are receiving from a governmental entity. Here, if you see a transaction in which the party receives commensurate value, a like-kind exchange is a yes, then that's obviously going to be a contract. If it's no, then you have the question of, are there conditions present for barriers for the agreement? If there's not, then you're looking at a contribution. If there is, you may have a conditional grant, and with that, you're essentially recognizing revenue the same way you would a contract, where if the money is fronted in advance, you'll record a liability or deferred revenue, and if the money is not, you'll have a receivable, and you'll record the revenue as it's earned through those conditions. And with the non-conditional grants from the federal government, again, they're ultimately acting as a contribution. Whether that comes with restrictions or not really depends on the wording of the contract itself, but ultimately it gets treated as revenue into the period when granted. So the effective date for this is actually the same as Topic 606. So for those organizations adopting 606 in 2019, you'll also have to consider these new changes to contributions. So with that, I'm going to move us into the second half of the presentation, which is the BDO's Nonprofit Benchmarking Survey. And what this survey is information was collected from different types of nonprofit organizations, 100 of them, as you can see, all over the industry and spectrum of what nonprofit organizations can do. It covered topics such as strategic planning, operations, scope and impact, human resources, as well as governance. The goal of the survey was really to provide nonprofits with a barometer for measuring performance across a variety of areas. Personally, I know my organization gets a lot of questions from our clients, particularly from members of governance. How do we stack up against our peers? How do we stack up against the industry? Are we a normal organization? Are we an outlier? And with this type of information, we hope to disseminate it and get, give governance members and members of management some more benchmarking. And if a lot of these issues your organization has not seen, or you're not even aware of yet, or you're not even thinking of, I think it's a really good opportunity to kind of visit these issues and plan ahead, because the trend seems to be moving in these directions. So a little bit background about the study. It was broken up into 3 different ranges of revenue streams: organizations with less than 25 million in revenue, between 25 and 75 million, and larger organizations who were 76 and over. The average participant responded had revenues of about 85 million, with total assets of 164 million. So, as sure as many individuals in this call are aware, the nonprofit landscape has changed dramatically over the last couple of years. Donor demographics are changing the nature and the business of giving. More individuals are giving smaller amounts through their phone, through websites, or word of mouth from friends. There's a growing demand for long-term talent, including leadership, turnover being a big problem with nonprofit organizations, retaining talent, working on succession plans, as well as everyone knows, increased scrutiny, both from governmental entities and from donors, leading to greater demand for reporting, accountability, and transparency through the reporting. With that, those who are relying on government funding are well aware of government cutbacks, and through those cutbacks, more scrutiny on how funds are being spent that are endangering a lot of nonprofits' futures. Impending regulations are adding additional levels of complexity to current compliance obligations. The cost reporting and the donor reporting that a lot of organizations are undertaking now is something that hasn't been seen ultimately since current nonprofit accounting has been in effect. You'll have the smallest donors asking for reports and having grant contracts being filled out with different reporting measures. Everyone's aware of the government reporting and the quarterly reports from your funding source and from its parent, department in the executive branch, and then you have your uniform guidance audits, and it seems like once you pick your head up, you have a different report to submit to somebody. So how can we make mission sustainable for nonprofits? So behind closed doors, many nonprofits have ambitious growth plans. From our survey, 62% say somewhat or very likely they will expand their programs over the next 2 years, while 2 in 5 worry about their ability to manage growth. But with that, audacity and expectations, very few have a financial safety net in place to help fund that or have something set aside for the proverbial rainy day. 51% have less than 6 months of operating reserves, while 35% have only 12 months of operating reserves. Maintaining adequate liquidity, where 34% do not consider liquidity a challenge, 40% cite it as a low-level challenge. As you can see there, 34% do not consider maintaining liquidity a challenge. That means 2/3 of organizations are, and 60% of organizations cite, above low-level challenge to maintaining liquidity. Again, it all goes back to the changes in the donor landscape and the changes in government funding. And generally greater competition between other nonprofits for the limited amount of resources. Then we have the famous nonprofit starvation cycle, where here you have nonprofits feel pressures to conform. They neglect infrastructure and misrepresent data in order to meet those programmatic goals. Fundraisers then have unrealistic expectations. If organizations are spending 90–95% on programs, to show a year where you're spending 10% more in admin looks like an aberration, and it's a red flag and sounds the alarm for the organization. With that, the cycle continues. There's more pressure, and so on for infinity. 1 in 5 nonprofits are spending between 90 and 99% on program-related expenses, and the industry average is 77%. So what's feeding the cycle? It's really a two-pronged demon. You have rising administrative costs just by the nature of the economy as a whole. Healthcare, every client I work with is facing the annual healthcare crisis where the costs just keep going up and you have to find ways to fund it. And you couple that with donors' expectations and the overhead myth, you're looking at organizations pushing that admin number down, sacrificing dollars that should be spent helping the mission in the back office. IT costs, cybersecurity is a big risk. HR, cutting finance departments, making reporting even more difficult in order to get this programmatic ratio higher than where it really should be for an organization to be successful. And where does the starvation cycle end? Well, it ends usually one of 3 ways: through consolidation between similar organizations closing their doors because they can't fund themselves, and with those closing of doors, other organizations being required to pick up the missions of these closed organizations and taking on those additional financial burdens. Program expansion is not always the right choice. Nonprofits need to make smart choices about which mission-driven programs are the right programs to fund. So navigating the top issues, the first being staffing and retention. So based on our survey, 60% of nonprofits surveyed struggle with staffing. 64% lack a formal talent acquisition strategy. 81% lack a formal retention strategy or program. From my experience, you almost never see organizations, unless they have great financial backing, that have a talent acquisition strategy. I mean, if you're bleeding employees or you're having a high turnover rate, it's almost like you're putting out the fire that's in front of you. The strategy is never about growth. It's about maintaining, and it's about putting your fingers in the dike to prevent the whole organization from taking the hit. So why are employees leaving? 59% are saying compensation, 58% availability of up-to-date technology, 54% communication, 51% management employee relationships, and 51% cite employee training and development. Regardless of the reason, employee satisfaction and employee turnover can be devastating to nonprofits, as I know most organizations are starting to see. Worse than just turnover is the frequent turnover, where you hire someone, get them trained, and 6-7 months later, a year later, you're looking to fill the same position again and retrain. And those costs don't always appear on the income statement, but they are time-consuming, and you lose that institutional memory a lot of times, and leads to delays in other areas and weakening of the mission. So some of the best practices for recruiting and training top talent in order to help combat this a little bit is you have to stay competitive in your local market. Make your organization an attractive place for potential employees. And I know that sounds like a bit of a pipe dream at times. Staying competitive is great if you have the resources to be competitive. But what I like to tell my clients is that whether you have the funds to be competitive or not, it's really still important to whether know you're being competitive. Because if you can't pay people similar salaries because you just don't have the budget, it's really important to know that, because when people come in for interviews and they ask the salary and you have to disclose a number and they tell you that's less than what they were expecting, there has to be a plan in place in order to pitch to those employees. What are the other benefits that your organization can provide to make up for those salary gaps? Is your culture phenomenal? Do they have more flexibility? Can they work from home? Are the benefits better than they would find somewhere else? Is the mission and helping individuals, is that a bigger thing than work and money? If you're not equipping yourselves with the knowledge to know that you're not meeting the market demands, then you'll never have the right game plan in place to get the right talent, or pitch to the right talent, where you give yourselves a chance, where it's not just comparing dollars. It's comparing dollars worth, a reason and a why work, as opposed to how much can I work for. Capitalize on flexible work options. Remote work arrangements can be both beneficial to employees and cost-effective for organizations. Granting people the autonomy to work from home on certain days, or be able to stay active in sick days. A lot of people live in two-family working homes now, where if they have kids, the kid is sick, one of the parents has to stay home and kill a vacation day. Nowadays, if you can work from home and put in a half day or make up the time later, that does wonders for people's lives, wonders for their autonomy and making them feel like they're in control, as opposed to being, a work rat who has to run to the office every day, or they have to burn their vacation time or lose that on a sick day. Little things like that can go a long way with individuals. And last but definitely not least, be proactive about succession planning. I hate using generational terms, but as the baby boomers are retiring out each year, plans in place, have succession, and give employees some sort of organizational game plan of how things are going to go and what positions will be opening up, or where they may see themselves in a few years. Is really important for maintaining your successful employees who want to stay with the organization. But what happens a lot of times, particularly at nonprofits, is upward mobility is usually stagnant. And with that, you get people jumping industries, jumping ship in order to grow their career. If there's a clear game plan in sight, you'll have a lot better chance of retaining, those exceptional employees who, for based on their circumstances, will not really be able to progress as quickly. But we do want to show them their road to that success throughout the coming years. And as I mentioned, donor relations before, there's huge changes to donor demographics nowadays. Millennials giving to charity 85% of the time. However, they're definitely looking more for accountability and transparency on how those dollars are being spent. Overall public trust in nonprofits is apparently very shaky. 49% of donors don't know how nonprofits use their money. It could be a donor problem or a nonprofit problem, but ultimately, at the end of the day, it's left up to the nonprofits to make sure their mission is getting out there, and for those prospective donors and for the donors who have given money, that they're getting feedback from your organization, how that money is being spent, and giving them, real goals and real examples of how you've been successful with their dollars. 1 in 5 are unsure who benefits from the work they're funding. So what makes up this challenge is for reporting purposes to these donors? I mean, lack of consistent frameworks internally. What kind of reports are you giving donors? How frequently? What these reports should look like? Lack of technology to create these reports. Human resources constraints. We just don't have the people. We just don't have the finance team or the development team in place to give these reports timely and to the level that individuals are asking. There's lack of clear program objectives. How do you know a program's successful? I mean, that has to be something that's quantifiable and demonstrated in order to show donors that you are being successful. And then lastly, inadequate financial resources. We just don't have the money to give the donors what they're asking for. And 61% of nonprofits reported that a portion of their funders required more information than previously required. So some of the best practices, we recommend start with the end in mind. What is the story you want to tell the stakeholders? Think about what the world could look like if your mission was achieved. Put these on paper, put these on your website, drive donors to these sources, let them see what that looks like. Again, with the new changes to the financial statements, you have another opportunity to kind of revamp your financials to mirror this mission. You can change the programs, disclose what you want to do on the income statement and the functional expenses, so that some more sophisticated readers and ththose who are looking at 990s and looking at financial statements can see those goals being met, on the balance sheet and income statement. Make reporting an ongoing process. Donors, board members, others in governance, make these quarterly or monthly reports that they're getting. They can see how your organization is performing and working towards those goals. Emphasize transparency. Share proudly and wisely. I mean, scream from the hilltops, mountaintops when you've been successful. Social media, again, you could have millions of people looking at tweets, Facebook pages, your website. Get these goals out there. Let people see the examples of your success. And constantly refresh your tactics. You don't want to have a stale game plan. You want to evolve. You want to stay current. Meanwhile, having the overarching goal of sharing your success with your donors. Mergers and acquisitions is another hot topic. 36% of organizations say they're likely to enter a strategic partnership with similar nonprofits in the next 2 years, while only 8% plan on a merger over the next 2 years. So what's making mergers challenging? What's causing nonprofits to hesitate? Well, it's the lack of necessary capital. They're worried the merger won't be successful to fulfill their mission. And probably most importantly, organizations, those in executive management, are not ready to give up control through a merger. They view mergers as a last resort or a ripcord option, not performing necessary due diligence regarding the possible mergers, understanding the true time required to do a merger. If you have mergers within the same state, that could take a really long time, and that's working with the same state attorney general. If you're talking about cross-state mergers, I mean, this could be very time-consuming, and it's really important to understand that cost of time, not understanding financial reporting, and failing to effectively integrate both sides of the stakeholders. Partnering up may have a lot of benefits. You can generate liquidity. You can enable access to shared resources and space, combine skills of the board and staff, advance the common mission, and reduce competition from the same donor bases. There are 1.5 million nonprofits in the U.S., and many have similar missions. Most importantly here, if this was for profit, as soon as the opportunity arises for synergies and to make money and to better the profit driving scheme, organizations jump to merge and to suck up other organizations. But with nonprofits, because you don't have that profit motivation, to merge, it seems like something you would never do again as a ripcord option. Whereas it may be beneficial. You may have two organizations competing for the same resources in the same geographical area, ultimately serving the same population. We're really just doubling those overhead costs, doubling those administrative costs, doubling those fundraising costs, where combined, they'd be more effectively be able to use those dollars to help the population they're looking to serve. So here, you want to find your friends, find the organizations that are in your area that have compatible missions, develop an internal peer group. Even if it's not to merge, compare yourselves to each other. See what organization A is doing right that maybe your organization can use to implement, and vice versa. Give another organization in your peer group advice on areas that they may be lagging. Introduce yourself to the boards through merger processes. explore partnerships, consider those with different stripes, nonprofit and for-profit, nonprofit partnerships are on the rise in the last couple of years. And commit. So lastly, just a couple of regulatory developments. Again, tax reform and changes in that area have really had a pronounced effect on donor giving, particularly in the Northeast, where the increase in the standard deduction while limiting the state and local tax deductions has really muted the motivation of a lot of individuals to give charitable donations on a whim. Individuals are still giving to organizations they genuinely care about, but the direct mail campaign where you get a letter in the mail and you feel at the end of the year you might as well give $25 because you can write it off next month. Those have certainly been, from the feedback I've been getting, it's certainly been taking a hit as of late. So regarding the compliance with the government organizations and the government regulatory environment, be careful about your deadlines. Look at the impacts of these regulations and how they're going to directly affect your organization. Look outside of accounting departments for information, business functions, such as your tax teams, financial reporting teams, and fundraising teams. And always double check your work. And so the last topic I want to quickly touch upon before the question and answer section, and as of late it's gotten a lot of press and a lot of headlines, is around cybersecurity and the importance of having the proper cybersecurity in place. So from our survey, 54% of organizations, so more than half, are concerned about cybersecurity, and it probably should really be 100%. The schemes out there have been much more sophisticated, spear phishing schemes, software being implanted on people's computers that doesn't go active until 4 months later when you never even know it's there, and now you're locked out, and that is being stolen. All these stories, you hear these horror stories all the time, and they're certainly on the rise. The stakes are higher now with the EU's General Data Protection Regulation. If your organization has data that's within your network and an EU citizen has information on there, you're now subject to this General Data Protection Regulation. And if you're not keeping this information secure, the fines are extremely steep. I think the minimum for total negligence is about 20 million euro, which is a significant amount of money for any organization. So again, you want to make sure your organization, if you have international employees or international missions, you want to make sure your data is being secure at all times in the most sophisticated manner. Some of the best practices: you want an internal champion, assess your risks, form developmental committees within your organization to take a look at cybersecurity risks. Consider cyber insurance. I would say implement cyber insurance. If you have computers that are connected to the internet, you want to make sure that data is secure. You want a comprehensive program. And lastly, communication is key. There should be internal dialogue, at least at every board meeting regarding cybersecurity. So ultimately, the benchmarking, why is it critical? It lets your organization know how you stack up. Within the document, I've attached some links that are going to be circulated with the PDF so you can look at the benchmarking survey yourself. The assessing yourself benchmarking tool is currently closed, but it's going to be reopened again for the third reiteration. Once that's open, organizations can go on and fill in information about yourselves and get feedback about how you stack up versus similar organizations. And again, the last couple of slides are just some more information on nonprofit resources at BDO, information on tax reform, revenue recognition, BDO nonprofit financial statements book, some links here how to obtain that. And with that, I will open it up to any questions from the attendees.
All right, we do have a few questions for you. The first question is, can investment income distributed for operations be classified as operating revenue?
So I'm imagining this is when part of the investment portfolio is appropriated to help offset current year operations. So if you're currently doing that, that won't change. What you will do is you will basically have two lines of investment income, which will have investment income above the line in operations, and then your non-operating investment income. The big difference there is that you'll no longer be required for those types of investment income to disclose either on the income statement or in the notes the source of that income, meaning dividends, unrealized gains, and realized gains. So if you're showing appropriations of investment income into operations and a piece of it into non-operating, that can stay. That won't change.
Okay. Next question is, will 990 form change to reflect the update on financial disclosure requirements?
So the short answer is not yet. The IRS has not released anything, nor have they gave an indication when they will release it. So for your December 31st, 2018 990, you will fill in the unrestricted assets or the permanently restricted assets as you always have. So you'll still have to maintain that information internally, as you should anyway under the new ASU. But the nomenclature is going to be the same on the 990. I believe that the intent is to merge it to the new GAAP language, but it's not. It won't be there for 2018 at the very least.
Just a reminder for everyone, if you do have questions, you can type them under the questions portion and they'll pop up so we can read them. As of right now, we don't have any other questions, but we'll give it a minute or so. All right, here came one. Do you know how these new standards, in particular those for leases, will impact Charity Navigator scoring metrics?
So I don't have any idea how that's going to happen. But I will say most organizations that have been working with nonprofits, particularly ones who work mainly with nonprofits like Charity Navigators, a lot of banks, we've given trainings to multiple different banks that we work with our nonprofit clients about how these changes in leases in particular with regard to recording operating leases now on the balance sheet as assets and offsetting liabilities, how that's going to affect the measures they use, and particularly for banks, your debt covenants. So I don't know any direct information, but I would imagine that this is going to be definitely taken care of and addressed. And I would imagine that Charity Navigator will continue to present the type of information they have been presenting in the same way. You'll just have to net out the asset and liability for those leases. You got to remember, at the end of the day, there's no real income statement effect for the change. It'll be an offsetting asset and liability. So I would think they would definitely take that into account to smooth the playing field among organizations. But I have not seen any literature or any correspondence from Charity Navigator or GuideStar or any organizations like that as of yet.
All right. Again, we'll give it one more minute for questions, and if we don't receive any others, we will call it a day. All right, Matthew, here's another one. We are a higher institution. Can we record investment income distributed for operations as operating revenue?
So yeah. So if you're a higher ed and you have an endowment and the board appropriates a certain percent to fund operations during the year, you would still be able to put that investment return as an appropriation into your operations. The only change being is if in the past you felt necessary to disclose unrealized, realized gains, your investment fees within the notes to explain what made up that investment revenue that was being appropriated for operations, that will no longer be necessary. So it's portion that the board appropriates it. What will happen is it'll still hit the same place in the income statement. In your notes to the financials, you will have to disclose the standards minimum of how the board determines those appropriations, if it's a board decision or if it's a management decision, what measures are taken into account in order to figure out how much. It just can't be, what you want to avoid is just having an appropriation that nets your operations to zero, so you're not showing a loss. That's frowned upon. So it should be something that's consistent and based on genuine contemplation and analysis rather than just a wanton decision towards the end of the year. But yes, you are allowed to show that operating portion of the investment return and your non-operating portion.
Perfect. Thank you, Matthew. So since we have hit the top of the hour, we'll go ahead and end for the day. So I want to thank everyone for joining us for our expert speaker series, and I'd like to thank Matthew for his time. We hope you enjoyed the presentation and that you'll join us for future events and webinars. You can find that on our website, going to jmtconsulting.com and clicking on the events tab. Thank you again, Matthew, and have a great day, everyone.